We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. Here in the studio today with Dane McKinney.
Oh, yeah.
He's done snowboarding in Japan. He came back to hang out with us. Michael's here. I'm here. And today we want to bring you an episode about optics. Is that what we're talking about? Optics.
That was what we were talking about.
What does that mean? Are we talking about...
That real estate is all based off optics, the fake interpretation of life.
So, like, are you trying to say, like, everything you see is not necessarily real?
Nothing you see on social media is real, unless you follow me.
My dad always used to tell me, he says, don't believe anything you hear and only half of what you see. So that means optics. Half of the optics that's okay. We can believe half of the optics.
Yeah. Okay. I would agree.
So kick us off, Dane. Tell us why you want to talk about optics right now.
We're talking about optics because we've been talking to a lot of people and hearing about a lot of people. There's a lot of deals that are finally going bad, I guess.
Ooh, there's blood in the water.
There is definitely blood in the water.
Why? Is this multifamily or all across the board?
So it's been across the board, and I think it's finally hitting multifamily.
So tell us what's causing this blood in the water. When we say blood in the water, people are in trouble. So what's causing people to be in trouble?
The main thing on the deals that I'm talking about specifically, and I can't get into too many specifics out of respect for the people, but is just buying in markets that look really good. Or have looked really good for 10 years and maybe shouldn't have looked good like 2 or 3 years ago in markets that they don't fully understand.
Let me guess, this is in the Sun Belt.
It is in the Sun Belt. Yeah. And so I think it's just it's the shiny, these are big cities, there's huge employment backers, you're always going to have workforce housing, you're always going to have people that are ready to build new apartments, there's always going to be people that need to live here.
Good fundamentals.
And when everybody thinks that all at the same time, you get oversupply. And so specifically the deals that I'm talking about are in places where they looked at the market in a snippet of when they were buying, but they didn't look at what was going to happen over the next 5 years. And frankly, I think that that's the advantage a lot of times in our markets, and I'm sure Mike would agree with this, is that especially when you're doing infill housing, it's like you have no concern, very little concern about oversupply in a lot of the places that you're developing or building stuff. I mean, I'm sure there is some
very
level
little
of
concern that bit me in the ass.
Yeah. Well, on condos for sure. But when you're building like 8 units or like 12 unit, like new nice stuff.
Yeah, like, the intensity of what you're delivering will determine the level of understanding of demographics, right? So if you're delivering 300 apartment units, you better really understand the demographics of that market. If you're delivering 4 new homes, you're probably less concerned about the demographics and just more interested in value.
To the other piece is, like, even if you were delivering 300 units, if you knew that you were the only person who could deliver those 300 units and there was nobody else within like a 3-mile radius of you that was going to be able to build because you're building on a lot that used to have XYZ on it and now you're doing infill, right? Or you're just the only lot that's zoned for that, which in Oregon is really common a lot of times, where it's like even projects that are 300 units that are coming through, usually that's like a 4-year process where somebody got a lot, like the zoning was changed. They had to pull the infrastructure really far from where it was before. They created a new turn lane. They had to stop, slow down, speed up. And so that like you don't have concern there.
Everything's known. So when I say demographics, your construction pipeline, your competition pipeline needs to be known.
Yeah.
It's permits are records. That's public records.
Yeah.
So you need if you're delivering anything from an inventory standpoint, you better understand the demographics of what you're delivering into.
Yeah.
Know your audience, but you also understand the process and more importantly, your competition, because you can know your audience, understand the process, deliver perfectly. But if you ignored your competition, and the other thing about like delivering housing is there's a certain threshold of cost that you cannot get below. But at the other end, you are delivering a commodity. And so when we're in a down market, your costs can't go any lower. The only way to deliver it is to lower the price, to squeeze your margin.
So it's interesting because we've talked about there being a real estate recession for the last 3.5 years. And over that 3.5 years, we've been looking for blood in the water. And it feels like we're coming out of that recession. And just as we come out of it, that's when like the covers come off. It seems like this is when the deals start to happen. And these are the first deals that sort of bring us back into deal making mode, is when there are people in trouble. Yeah. And so here we go. When people are finally in trouble, this is the first inning where you start putting your name on stuff. So what I'm interested in talking about is a few episodes. Mike mentioned something really important, saying that, you do have to look at a market from an oversupply standpoint and know the pipeline of new development, but also how do you see what's in the stars when it comes to the under demand side of it? And so when you get both at the same time, it's like, sure, you can take a market that gets too many units all at once. We had it happen right here in Salem. Now we're seeing all those units get absorbed. We're seeing that this is all going to burn off and it's going to be fine. But it was exacerbated by the fact that we got too many units all at once and we actually had less demand than we had before. So it hit us from both sides. When you get that in a little market like Salem, Oregon, it's like it screws us up for a bit, but then it sorts itself out. We looked at deals during this time over the last 3 years. We actually chased a deal. I think that was a 500 unit deal in Texas. And you remember my comments about that? It's like, I'm a pretty aggressive guy, but I'm like, guys, we're not from Texas. We don't how are we going to go in and understand this market, understand where the demand's coming from, understand if it's going to be oversupplied. And then if things go wrong, which one of us is moving to Texas? Because that's what's going to happen. And that's what's happening to a lot of these players out there right now. Is they're having to change their whole lifestyle around. They said, let's go big. Well, if you want to go big, you go to the Sun Belt, because you don't build 500 unit complexes in Oregon very often, but in Texas they pop up
all the time.
Every mile you drive down the highway, you see another one, right? They're everywhere.
There's cities all over the place.
So it sounds really cool because you can go there and buy a really big project, but then it's like, do you have the infrastructure? Do you have the manpower? Do you have the management team? When something goes wrong, do you have contractors that you can rely on, that you can trust to get the job done and not try to screw you over? Like, I've just, even leaving and going doing deals 3 hours from Salem, Oregon, it took us a while to sort of build those teams up to where, I mean, we had contractors trying to screw us left and right, people failing projects, people not getting stuff done. Like, we ran into the good old boy club where the city wouldn't, permit us to do something until we brought in a local partner that was willing to push it through. Like, I mean, there's a 1,000 little caveats to being successful in a market. And it's not just the numbers you see on a paper. Oh, there's good employment, there's good income. They need units. Let's go do units. I mean, there's a lot more to it to operate a business once you're there.
Yeah, like if you look at the demographics of the Oregon coast, people fail at the coast has nothing to do with value, and it has nothing to do with population, and it has nothing to do with households. It has everything to do with good luck finding a competent fucking contractor that's not going to rip you off. It has nothing to do with demographics. It has everything to do with, can you implement a business model?
How do you run your business over there?
So you have to frame a business model inside of demographics, but you have to have the special sauce to implement the business model. And that's where a lot of people just have no business being a real estate operator or being a business buyer. Like, the biggest bubble right now is the business purchases. I'm in a community, a great community. I love this community, and it's all about buying businesses, and it's all about action, and they raise a ton of capital. They do a whole lot. But there's also these Fail Friday posts. And a lot of those people that they were going to their openings and their business purchases and their celebratory dinners, and now they post like 12 months later, we haven't had a profitable month. We've had to fire this person. We've had to do this. And the optics are, this is really good on paper. That's the optics. And the first thing you need to understand is, when you look at something on paper, that isn't life. And you actually have to understand how to bring it to life. And most people do not know how to bring it to life.
So these big dogs are getting in bigger trouble because they are able to raise, I mean, these are people that are raising hundreds of millions of dollars. And they're doing really, really big plays. And they have to go all over the country in order to make these plays because they can't stay in one local market. When I interviewed with Rod Cleef on his podcast a few weeks ago, and he made an interesting statement. He goes, everybody I know that's really successful found a very specific geographic location to work out of, and they built an they built a vertically integrated company to be able to handle construction management, all the things, right?
Yeah.
It's when we start looking at going, hey, we've tapped out on Oregon, let's go identify another market. That's what everybody does. And they go off and they go, let's go find 3 or 4 or 5 other markets that we can play in. And you start studying it. To me, when you're looking at population growth and what are the school scores and all the stuff, you can really see it in black and white, but you're not there.
Yeah.
You don't really know which way the wind is blowing and what is happening. Are people excited to be moving in? Are they moving out? Data will take you so far, but I think there's some sort of like artistic instinct side of this that you're missing when you go somewhere else.
Yeah, and your intuition gets honed with experience and time.
Well, and intuition is it's experience and time, and you discredit like gut feeling, because I think for a lot of time when we started working together, and you would never actually underwrite anything. By we, I'm saying for everybody listening, me and Gabe started working together. Gabe never underwrote anything. He would like barely look at the property itself. It was like super high level, show him 5 pictures of the building, and he would tell us exactly what it was worth, exactly what we should do with it, what we needed to buy it at for it to make sense. And what I didn't realize at the time was that it was just 10 years of like the curve to getting to be an expert that was in play, and you were at the expert part of it already. And so I was at the beginning part where I have no idea what I don't know yet.
You got to do the math.
And then you have to feel really, really, and I have to do the math to then feel really dumb and really like not want to do deals, frankly. Like, because you get to the point where then you're like, well, why is this deal even on the market? Like, what is wrong with it? And so you're in the fear part because you don't know what you don't know. And then you get to the point where Gabe, like, you'll look at a deal and it's like, I know all of the things that could possibly be wrong with that in a specific place. And so that's what we have to offer to make the deal make sense. And we're finally there. Trevor and I have probably been there for the last like 6 months to a year, where it's like, okay, now I know what I know, and I know what I don't know. Like, I know the things that could possibly go wrong. And when you go to a new market, it's like you have to reset. On a number of those factors, right? You have to reset in a ton of different ways on it. Whereas like we had that deal in Oklahoma that somebody called us on. This was so funny because I was like, I just have to call one guy. Like, I know the one guy who's going to because he's the guy who already has the expert part of the curve rounded out in that market. And I called him and I told him broadly like what the project was. And then after I broadly told him, because I was like, I don't really know if I should give away too many details, like out of discretion for the guy who brought it to me. It wasn't really my deal. And then he told me the address and he was like, don't buy it. Like, that's not your deal. And this is
he already knew.
This is a 250,000 person market. It wasn't like it was 12,000 people. It wasn't like it was 25,000 people. There's 250,000 people there. And he told me the one complex that I was talking about that was like 84 units. Like, it wasn't even huge. It was just like kind of big. And he was like, yeah, you can't buy that. And then broke down exactly why. And like told me which building had burnt down. He was like, I looked at that like 3 years ago. I was like,
Anytime your market is dependent upon money coming from another market to support your investments, aka the Midwest and the Southeast, which is high income Californians buying high cap rentals in the Midwest.
Oh.
Anytime your sales is based on selling to someone outside your community, your sales are based on selling to an uneducated human being.
Yeah, they're not in the know yet. I mean, they might be educated in other ways, but they're not educated in that market.
It's just a matter of time until they just realize that's not a bad
asset. So back to optics. This kind of scares me in a way, because these big players are sophisticated. They've got big teams, smart people. You know, these are like Harvard grads sitting in the big skyscraper somewhere. Like these are big companies that are going out and making these mistakes. So what is it that they did not see coming?
It's the nature of a low yield and value add environment. So anyone who raised a large capital stack and placed it anytime between 2019 and 2022, you're fighting two things. One, you're fighting low yield. So anywhere you placed your capital,
you bought at a low cap rate.
You're buying at a low cap rate. And so then the only way to then create a capital stack you could deploy was based off value add real estate, which is based off of assumptions and projections. And now you're then taking money based on a business model And we are in a financial recession at the commercial real estate level. It's just simply what it is. The demographics, the fundamentals are wrong.
Hey guys, Gabe here. Have you seen the exciting new projects we have going on at Stack Asset Group? If you're interested in investing with us, click the link in the description below.
And so now you're in a business model that doesn't have it has to be deleveraged.
Which means their assumptions were wrong.
It's not even that their assumptions are wrong. It's just that, yes, it's their assumptions were wrong.
Because their models had baked in. Okay,
crystal ball was wrong.
Yeah, their crystal ball was wrong. We're going to raise rents 3 or 4% every year over the next 5 years during a whole period. And then guess what?
Yeah.
Rents went back 5%, 10%, 15%.
It's important.
What do you do?
Yeah, it's important for people to understand is projections are not projections. They're estimates. They're assumptions, right? And
guesses.
It's a value add component is based off of assumptions, and your assumptions can be really good valued assumptions or they can be guesses. And so in the syndication world, you have this whole spectrum of guesses and and educated assumptions, right? But even with that, you have a once in a lifetime market correction essentially happening, but being sheltered and hidden and manipulated, right? And so if you have a big enough capital stack and you can just wait out, you're fine. But if you raised capital based on an event that required a sale or a refinance, you have to deleverage to make that happen.
Yeah.
There's no ifs, ands, or buts. If you're going to sell it, you either take a huge loss, maybe write a check to sell it, or you just give it back. Or if you're going to refinance it, you have to bring capital in. So the business model no longer works. And so now as a syndicator, your options are, well, do I raise more capital? Well, people don't want to throw good money after bad. Mm-hmm. Or do you sell, but what are you selling? All the LP capital's gone. Now you're to the bank level. The bank may or may not want to move, and you don't get any benefit from then taking that, right? So now you have this mass group of operators that have raised billions or hundreds of billions of dollars. Some of them have the capital stack and the business plan to just weather the storm. Some of them are giving up. Some of them, their reputations are getting thrown through the mud, even though they're not bad. Some of them were just crooks and never finished it. And so the optics are anything you want them to be is reality right now. That is what's the reality of the market.
Is this why it's so hard to raise capital?
Yes. Yeah. Because you have the easiest period of time ever to raise capital. One, because capital was so cheap and it was just a low yield environment. So the baseline expectation was low. Two, influencers. It was the Instagram model. So too much money, really low cost of capital, no real due diligence, no real professionalism, money being thrown everywhere. It's like, oh gosh, I got $100,000 followers. I can tell them about my friend. My friend will pay me $50,000. He'll get 500 or 50 million and now go to work. So it's just a bunch of amateurs in a bad market cycle. It is a bad market cycle. The timing between 2019 and 2022 and deploying a shit ton of capital is just high risk. It's a really bad market cycle.
You know, it's interesting. I was always taught that rents never really went down in our market, that it would drop. You know, the one time it dropped 1 or 2% for 6 months, but rents would go flat for 5 or 6 years sometimes, but they never went down. Mm-hmm. Values would drop in multifamily, but they would drop by like 10%. There wasn't ever really this big swing. So the risk was only that you might go like stagnant, essentially. But what COVID did is it changed all that, because we got a bubble in our rents, in our value. We got free money, loads of money. Rents went through the roof. Rents were going up 30-40% in a period of time they shouldn't have been going up 30-40%. And we knew there'd be some sort of reckoning, but the reckoning is really what we've experienced over the last 3 years, where that bubble popped and there wasn't enough money, and then we got oversupply at the same time, and then rents, they did go down. They went down further than they have in the last, I don't know, maybe since we've been recording rents, to be honest with you, in the last 3 years.
Yeah.
But they went down, if you look at it over the last 5 or 6 years, they went up too much and they came down maybe a little lower than they should have been, in my opinion. I mean, I think, you know, just on a very simple math, I'm a back of the napkin guy. You know, I can remember in 19, we were trying to push a 2-bedroom, 1-bath to about $1,000. Mm-hmm. And it took us like 6 months to rent the unit. It was the first time it ever took that long to rent a unit. We were just trying to breach that $995. How do we get to $1,025? Mm-hmm. And it took months to get there. And then suddenly, once we got there, then everything was at $1,000 immediately. And then it just went straight from $1,000. to like $1,450.
Yeah.
You're like, and Paul always taught me, like, once it breaches a certain milestone like that it'll just be off to the races. But it's not supposed to go. I mean, it took years to go from 700 to break 1,000, and it literally seemed like it took months to go from 1,000 to 1,400.
Yeah,
didn't make any sense. So now today that unit rents for 1,200.
Yeah.
Well, if you went back 5 years ago from 1,000 to 1,200, I'd say we're a little on the lean side. Like, if rents are going to go up 4 or 5% every single year, we should be getting that's about right. I mean, we should be getting 12.
If you compound
50,
it, it's a little low, but yeah.
Yeah. So I don't know how much of it is actually. I think it's just sort of like some people call it froth or whatever. It's like the froth that was on top of the market a few years ago went away. And that's what we experienced, was just like the craziness.
Yeah, you're talking about expense load at the personal level. So I've been thinking a lot about this. I read a really good post, probably some of my best writing, called "Don't Be an Ignorant Millionaire." And so the one reason I don't like economic textbooks is textbooks that were written 200 years ago were based on this premise where we can make more money than our parents. Right? Like, our parents made more money than our grandparents. They made more than our great grandparents. We're in a generation where generations are making less money than we are. Right? And so I was working with ChatGPT, and I was like, here's what my life was in 1997. This is what I made. This is what minimum wage was. This is what my rent was. This is my car payment. I spent $30 a week at Winco. And you come up with an expense load. Like, your basic operating expenses as just a human being, right? So we understand at the real estate level, we need to have a vacancy rate because that allows us to move things, right? At a personal income level, we need to have excess so we can save and we can invest so we can get ahead. When I was young, it was very easy for someone like me to say 15, 20, 50% of your income, because our basic level expenses were a low expense load to just maintain a normal life, right? Does that make sense? Now, a person who's in their 20s or 30s, their expense load is significantly higher than ours just to maintain their life, to stay. So instead of having 15, 20, 50% of your income to save and invest, you have 5% of your income. And so then now when your food gets more expensive and your gas gets more expensive and your electricity gets more expensive and your cell phone gets more expensive, everything gets so much more expensive and you're already loaded. Now you have to start making shelter component decisions and car decisions that we didn't have to make because we were always on this upward approach, or we had the ability for upward movement.
So going back 20, 30 years, what was the percentage of rent to income versus what it is today?
So I can't answer that, but I look a lot at the affordability on the purchase side. So historically, we're like 120% affordability. So that keeps, and then we also had options. So when you have affordability and you have options, prices don't increase and you can afford what you're buying. And we rarely ever got under that 100%, that 100 threshold. That 100 threshold was only breached in 2006, and it was for a short period of time, and then affordability shot all the way up to like 130 because prices came down and rates came down. We're down at like 90 now, and that's up from the low 80s, right? So we're in the cost of home ownership as a ratio of your income has never ever been this high.
Yeah.
And so that then puts this undue stress on every single expense inside of your household.
So the households are stressed, and so are the operators.
Correct.
Because when the froth burned off, that's when expenses took off. And insurance went up 35%, and all these utilities went up.
And they had no one they could unload those expenses onto.
Yes, but when your expenses are going up and your rents are going down, you're basically in our market, we experienced, I guess you'd call that like a stagflation. Like everything's moving in the wrong direction. Mm-hmm. So then you multiply that onto a $80 million deal.
Correct.
And now you go, we're working on a very, very low margin, very thin margins, buying it 3%, 4%, 5% cap rates or whatever, depending on what market you're in.
Yeah. And
then interest rates jump to 7+%. Expenses go up, rents go down. It's just a perfect storm.
It's really quick, like from my perspective, I guess, I think that a lot of the reason that, and I'm lucky that I just came in right before the crash. like right before everything got really bad. I seriously think I'm extremely fortunate.
I told you were.
No, I know. You told me I wasn't.
This is a perfect time to learn real estate.
I didn't believe it, right? Like, I believed it fundamentally because I was like, okay, this is good, right? Because if I can figure it out while it's really, really, really hard, then, and while like it's the worst that it's been in a long time, if, I don't know, then when it gets good, like it's going to be a lot of fun.
The people that came into the business, it's getting fun now. The people that came in 2 years before you,
oh, they're so stressed right now.
They made a bunch of, well, they're not even in the business. They made a bunch of money for a couple of years, and half of them aren't even around anymore because they're like, what in the hell?
What is this? So hard.
They got spoiled.
No, 100%. And so I think we had to build the structure, but to that point, I got to learn from a lot of people's mistakes that I didn't have to make myself, first of all. Second of all, I think a lot of people got into real estate that didn't have a fundamental understanding of the economy or investing in general. And so a lot of the guys, when you're looking at the operators that are failing, it's people who had a background in like small real estate ownership, and they're so used to leverage being their most powerful tool, as opposed to just a broad like understanding of investments in general. And then you look at like the BlackRocks and how they're calculating returns and how they underwrite deals. And like PE funds are naturally, when they look at a deal, they're not looking, I mean, yes, they'll look at a cap rate, but they're looking at their unlevered like yield on cost, right? And so when you look at a deal and you say, hey, my overall return on this 3 cap that I'm buying is going to be 40% per year, assuming that cap rates stay at 3% and I can increase rents by X amount, right? Because you can increase value so much more quickly at a 3 cap, but you can also decrease value so much more quickly. And so that's why if you were to take all those people and you were to say, hey, here's this deal that you like at a 3 cap, but instead of buying it with $60 million of leverage, whatever it is, or with, you're buying $70 million, if you're buying a $100 million deal, you have to buy it with $100 million. Are you still going to buy that deal? It's because when you're looking at it from an unlevered perspective, which is how, like the deal
not if I can make more than 3% somewhere else.
Totally. That's exactly is right. It's like you would never buy that deal, right? And so the deals kind of make sense, but you had to have known somewhere that cap rates couldn't stay at that level for long.
This is what I want to get at. Is these are some of the smartest people in our industry. How come they didn't see this coming?
So I don't think that it was the people who came from PE. That's what I'm getting at. Like I think
it wasn't private
equity. I don't think it's the people who came from private equity. I don't think it's the people who came from major institutions. BlackRock is sucking these assets up like crazy. They're the ones buying these. And so that's what you have to think about is the people that were buying the 300 unit, 200 unit, 400 unit complexes in the Sun Belt were competing with BlackRock or whoever it is, right? FPA multifamily, like all these major institutions. The only way that you win is if you know one specific market in one specific area better, way better than the people who have been in deals for 40 years.
Or you're playing in a market where they're just not going to go to.
Or you're playing, and so that's what we're doing, right? Is we're playing in markets where like REITs don't have, pension funds aren't going to go there.
Right.
And so we're stoked. And we're frankly, like, even when we go to markets where they will go, we're staying at the deal size that's lower than what they want, right?
But I think to your point, what happened was, and Mike said this, you had kind of the smaller player that was out there that was finding some success. And you get into 17, 18, 19, 20, and you feel like you're the king. Like, look at what I did.
Change is really good.
So what does everybody's ego want to do? Everybody wants to go from small operator to institutional operator, and this is your chance. Now you have the track record to raise the capital. You have the bandwidth to be able to go and borrow money and do all these things to go into your first $100 million deal. And so you do it, but you do it at the exact wrong time.
I don't think that intelligence.
A lot of that. You saw a lot of little infill guys that, we're going to build apartments.
Yeah.
They got out of their lane and then they got overexposed and they didn't know how to, 1, evaluate it for exposure, and then 2, get out of it when you are in it.
Yeah. I mean, being extremely intelligent does not mean that you don't have an ego. I think everybody across the board has the same propensity to have an ego. And on either end of the spectrum of intelligence, the dumbest and the smartest, I think you have the people who have the highest propensity to have it.
Yeah, the more intelligent you are, the easier it is to not to let it take over.
Well, when you're in the middle of the bell curve, you know you're in the middle. It's like, dude, I know there's a lot of people that are way smarter than I am.
That's why
there's a lot of people that are dumber than I am.
That's why when anyone asks me how I'm doing, it's always a weighted answer, which is there's positives and there's pros. Like I don't ever want to just look at the positives. I don't want to bring.
You mean
negative.
there's positive and negative?
Yeah, there's always pros and cons. Like there's always good things, right?
I asked Mike this morning. I
So
said,
everything is good.
What did I ask you? I said, are things going good or are things going bad? And he's like, both. Isn't that always the answer?
Yeah, should be. Yeah.
I mean, I've changed my cash flow projections and liquidity for the end of the month about 18 times, but everything's great.
Yeah.
It's hard. We were talking about that just to try to put some money in the bank account. It's like, oh, we're going to sell something. Nope, that deal failed.
Yeah.
Oh, we're going to refinance something. Nope, that loan got kicked out a month. Oh, we're going to, it's like one thing after the next. It's just like, why does it feel so hard?
It's hard to get deals done right now.
Yeah,
there's a lot of good deals, but there's always going to, I guess I haven't been in the good market.
Maybe they're not good enough yet.
I think so. I do think Trevor and I were talking till 10:30 last night about a new plan that we have for capital raising, but and how we pitch it to investors. I think we were just doing it wrong. I mean, we have to get to, if we want an institutional investor, we have to talk like the institutions, and we're not doing that, frankly. To your point with like ROMs are really good for who they're for, right? But if we want to get to the next level, it has to be, we have to compare it to the people that are already at the next level. So, and we hadn't been doing that, but I think the deals can be really
knowing your audience, and you better know your audience through that conversation.
We changed, we had to change our audience, but we didn't. We were still looking at it from the first party lens instead of
a different audience.
We weren't looking outside in; we were looking inside in at what we already had, and like, how do we adjust what we already have to the new audience? But it's got to be a whole new thing, right? And so that's part of why I've been like,
it's not a whole new thing; it's just a different frame.
It's a different frame, but package. Sorry, deliverable.
Mm-hmm.
But that's part of why I've had to be thinking about, like, how do the institutions actually look at all this stuff? Because one of our investors has a lot of experience with institutions, and he always talks about unlevered yield on cost. And so I've been thinking about it for a year and a half, because the first time 2 years, because the first time we did a deal with him, like, that's all that he would talk about. And it was like, that's not what we're even looking at. Man, like, we're looking at how much money we can make with a bunch of leverage. Like, we got a bunch of leverage on this thing. That's what makes it such a good deal. And it's like, no, I know that, but like, what's our unlevered yield on cost?
Because
I don't even know.
That is the only way to truly extract risk out of it. So the first thing they look at is, how do we lose money? Mm-hmm. Check. Okay, great. We're not going to lose money. Mm-hmm. And then they look at, what's the cost to move money into it? Like, that's why they work off of low yields.
Yeah.
And they want an unlevered cost.
Yeah.
Explain to us unlevered yield on cost.
Yeah. So
what's the math behind it? It's just it's just your ROI. It's just like, if I paid cash for it, how much return am I making?
A good analogy is like, look at your average, like your typical value add project is essentially you have some income, you're going to strip the income down, you're going to bring the income up, right? If you do that with leverage, if your yield at acquisition is 4%, you're buying at a 4 cap, but your debt is 6%, you're fucking bleeding.
You have negative leverage.
Your negative leverage plus all the capital that you brought into it. Whereas if they look at it and they're like, okay, it's a 4% yield. We're just looking at it as a 4% yield on cost. If we don't get any debt, that's our low risk, right? Okay, great. So now that's our downside. Now, what are the ways to get it to a higher yield on cost? And then you want to make sure, well, guess what? If my debt is going to be 6%, I need my yield on cost to be a lot higher. So that way I can take out leverage and get yield on the leverage. And if I'm getting yield on my leverage, it also means I've got good return on the capital I've invested. And so that's where you get your cash on cash return that you're ultimately trying to get.
Your money that's in.
But it all starts with yield. That's real value.
So on your cost, it would be the money, if you were to pay cash for the property plus the money that you put into it. For CapEx.
And so that's the way that on that project.
And what's my yield? Once I do that, what is my yield on all the money invested?
Yeah. And so that's when it really started to click, was once we came full cycle with that project, because then I had hard numbers to look at where it was like, oh, that's why he didn't even really want to refinance it. And if we did refinance it, which we ended up refinancing it, but he wanted to refi at a way lower amount. He just wanted to refi out our initial debt and then leave his money in there. And that didn't make sense for us. And he knew it didn't make sense for us at all, the way he wanted to structure it. And I just sent him an email, and I was trying to be genuine. And I sent him kind of a breakdown of what the returns were going to be on our end. And then I said, why would we want to do that?
Yeah.
And then he responded, and he was like, you probably wouldn't. Yeah. He's not he's really smart. He just asked for what he wanted. And then I was like, I don't know why I would want to do that ever. But sorry for rambling. We bought that deal at $3 million, put in $800,000. Our total cost was probably $4 million. So our dollars in, quote unquote, were $4 million, but then it was worth 7.65. It got appraised at 7.65. And so when you're looking at yield on cost, you're looking at what would the cap rate be of this project if I bought it for $4 million. And so it's like, okay, if I sold it right now to somebody for $4 million, what is that cap rate? So we turned something that when we bought it was like a 2.8 cap or something, which we didn't care about because it was heavy value add, but we turned it into like a 15 cap or something if we had sold it at $4 million, right? But we wouldn't have sold it at
such
$4
bad
million.
verbiage. You turned it into a 15 yield.
Yeah, we turned it into a 15.
Yield is intrinsic and cap rate is extrinsic.
Explain.
Yeah. Well, that's what they need to understand yield is intrinsic. That's what you're getting.
The cap rate's based on your return if there were no
You
leverage.
do not have a cap rate in your deal. No one has a cap rate in their deal. A cap rate is a market term. Everyone has a yield in their deal. Now, you take your NOI into a cap rate to get value, but you have a yield. The market has a cap rate. The market says we will give you this much value for the return you can create, but your deal is all about yield. And so if you can communicate in terms of yield, that strips extrinsic bullshit out of it. So like your yield on cost, that's the true fundamentals of your deal. Your levered yield then is just, well, does your financing add to it or
take
away from it? But the yield is the fundamentals. And you bought with a 2.8 yield and you turned it into a 15 yield. That created a shit ton of value. That's all you have to do. Create more yield than you bought and make sure that yield is more than your debt.
So it started off as bad yield because we were levered at a higher rate than 2.8.
Make sure that the yield is more than your interest rate on your debt.
Yeah. He said you bought it at 2.8 cap. So your yield at acquisition was 2.8. You took on debt at 7% because you had a very clear and easy business to get to 15. And even if you got to 12 or to 10, it would have been successful.
Yeah.
Well, we underwrote it to probably more like a 9 or 10. It hit a 15.
We
so
did,
it's just like a knock it out of the park type.
And that's where most success comes from. Most success comes from your assumptions were underestimated. And you blew it out of the park, or the market changed in your favor.
And that's why I was talking about earlier. Like it was so hard to underwrite other people's deals in 2022 when I got into it, and why you were like, this is the perfect time to get in. It's because I was underwriting other people's deals that they were closing on. And I was like, this doesn't make any sense to me. Or like deals that got closed in 2021. And I literally couldn't process it because I was like, well, these guys have been doing it for like 4 or 5 years. Like they're really smart guys. Like there had to have been some ego component because they knew so much more than I did. But I just couldn't make the deal pencil because Trevor taught me how to underwrite, and Trevor's the most conservative underwriter in the world. He'll underwrite a turned unit lower than he has a unit rented next door that he owns that's kind of junky. He'll underwrite it lower because he's just like, well, but maybe, if the market turns around, like I need this project to work. If rents are $100 lower on the nice unit,
you always want a partner like that.
Yeah, 100%.
And then when it outperforms, they call you, can you believe this? And hit that, and you go, yeah, I can believe it. I told you that's what it was going to do.
That's what was going to happen.
Yeah. But you buy the deal with a lot of conservative underwriting. So back to optics. Mike made a comment before the show talking about like when you invest with an operator, are you investing with a partner or are you investing with a syndicator? And I think to answer your question is why were they doing that deal? Syndicators, once they get maybe all syndicators, or if they're big enough, they're living off fees. And you have to be transacting in order to keep your machine rolling. You have to have act fees, dispo fees, refi fees, and all these fees. So if you're not able to close deals, you're not able to stay in business. I think that's the takeaway.
That's exactly what it is, because you only get paid when you buy it, and then you get paid when you sell it. The management fee in between is just kind of maintenance
Overhead.
cost. Yeah.
So all of us are syndicating to an extent, but the way we syndicate is much smaller, and we treat our investors like their partners. Correct. And the idea is we're investing alongside you. We're doing deals because we want to do bigger deals or more deals, and we can do that with you. But we're not just a syndicator who raises money and makes act fees. We're actually a partner because we're in these deals. So you want to make sure when you find an operator that they're actually your partner and they're investing their own money into the deal.
It's a great time to have this conversation, because the difference is we are investing for yield rather than fees. So if you're investing for yield, you're in it to the end to make sure that yield shows up. But if you're investing, or if you're a syndicator and you're just doing it for fees, once you see that the end game no longer works, you have to go to the next game. You have to find a new project, you have to raise capital and give up on the one that you're in.
That's why they go after the bigger deals, because there's bigger fees.
Exactly. So, but if you're invested in it for yield, you're invested to the end. And that's where most people don't understand. They're not investing in a partner. They're just, this guy's getting some fees, and they don't really truly understand, love, and feel it.
How come you don't hear more about these? I mean, there's some big names in syndication, Cardone, and I mean, like, are these guys in trouble? Are they not talking about being in trouble because they're still out trying to raise money? So are they keeping this sort of
Well, I can
secret?
tell you how one Ponzi scheme worked. So I saw this with a group of friends where a lot of them were in with a bad operator, and really it's literally a Ponzi scheme.
What made them a bad operator?
They weren't actually putting okay. So here's a ratio. If you're going to invest with the syndicator, here's a ratio I thought of that every passive investor needs to think of. What's the ratio of the capital raise, the total capital raise going to down payment versus CapEx? Like if you run into that number, there's your safety component. So think of it this way. So we're doing a 30% down deal, right? We're raising 2.27. 1.8 of it is going as a down payment. That's equity.
It's in the deal.
Equity gets returned, right? Now, because we're doing a 30% down payment, if we structured it as bridge debt and we're doing a 10% down payment and a heavy value add through CapEx, now 600 grand of it is equity, is down payment, and 1.6 is CapEx. So in scenario one, where all of it's down payment, you don't need to deliver a high quality business model with your CapEx. But if the majority of the raise is all CapEx, that's a business model that has to get implemented. So in scenario one, we don't have to do a good job implementing it to ensure you get a return, because we're ensuring you're getting a return because it has income and we're putting money down. Whereas if you have to do value add, you're stripping the income down because you got to do renovations.
And if your operator's doing a poor job, they're either not getting the job done, or they're using that money for something else, or
the worst scenario is they're giving you distributions out of CapEx to keep you happy so they have a good name and they can go raise money for the next deal. And that's how it starts. And you do that once and it isn't that bad, and you get another deal done and you think you're okay.
It all starts to stack.
And you do it again and you do it again.
And then the music stops and you don't get the next deal, and then you're screwed.
And then you go to prison.
And what you don't.
I don't think so.
No. And then the way that music stops is your investors communicate with each other. So at some point, someone sees something wrong, the red flag gets waved, and then conversations happen, and then you get cut off.
We've had so many investors over the last 6 months that have come and said, like, yeah, I was invested with so-and-so down in so-and-so, and they just stopped paying distributions a couple of years ago.
Yeah.
And
so
now the deal, we kind of just sold and like got our money back on some, didn't get all our money back on one, like made a little return on two of them.
So we talked about this being the hardest time to raise capital. So here's a really good example where I was talking to an investor who's invested with our friend down somewhere that isn't going as well. Then they've also put money in with Sang and Bob on they paid 99 grand a unit. The units are just like my 46 unit. except they ran it $800 a month instead of $1,600 a month. So guess what? You have to strip down all that. So there's no distributions because all the capital raise is CapEx. And so you don't have income to distribute. And so I'm talking to this individual. He's like, oh man, I really like this. I don't like the one deal down there because that's just terrible. Oh, I do like Bob and Sang's, that's just a really good basis. And I'm like, okay, well, have you gotten any income? No. Okay, well, let's do the math. Their all-in cost per unit is actually a little bit higher than my 46 unit. And you have to wait 18 months to get any distributions before that basis is locked in. From day one, we have the basis you want and the income that goes along with it. Oh, well, I just don't want to, because they don't understand what they're investing in, right? So they got a bad experience with one. They think they like this one, but they haven't gotten any distributions. So I'm offering something that is day one, the end game of the last thing they invested in, but they don't want to invest because of their experience of the past. Yeah.
They're gun shy.
Yeah.
Yeah, and you really got to align yourself with your investors and find out what it is they're looking for.
That's the hardest, yeah.
Because if they're looking for a big equity pop, they're not going to get distributions for a year or so while you stabilize the property. But if they're looking for stable cash flow, and I think that's why a lot of the big dogs were out just buying brand new product on a little tiny margin, because it's like, hey, it's a big Class A, it's going to be fairly stable and all these things. And even the most stable markets, the most stable, buildings saw the same thing everybody else did. Expenses went up, rents went flat or went down.
Interest rates went up.
Interest rates went up.
Yeah.
And it's just, it's a disaster.
That's a recipe for disaster.
It's a disaster.
Yeah.
So it's amazing to me that we're making money in our companies during this time.
Well, I mean, we didn't buy for 2 years.
You're buying for yield. Why would that surprise you?
I don't know. I guess I shouldn't be surprised.
Well, it doesn't, because we didn't buy for 2 years. That's why. The people that wanted to keep buying and had to keep buying, we didn't have to buy, and so we didn't buy. And it was a bummer because we had to do other stuff that was not anywhere near as fun. But then, earlier this year, the floodgates opened, right? Now it's like we have too many deals. We've got too many deals. We don't have enough capital for the deals. We don't have enough. I don't even know if we have enough bandwidth for the deals, even if we had enough capital, right? But it takes saying no to 100 deals, 200, more than that, probably 1,000 deals over the last 2 years, so that you can get to the point where it's like, oh, deals make sense. I don't know why, but they do now, right? Like, it just, you hit the threshold where it's like, and also part of it's that there's people struggling. And so, I mean, we've got 8 deals that we're looking at that are REO right now. And so, or
REO meaning the bank controls them?
Yeah, the bank controls them. And so, some of those are just going that direction, and some of them are already there, right, where we're just talking to the bank about it. But that's why deals are getting so darn good right now. Banks are great sellers. So
going back to optics, there's hard money people that are in trouble right now, because
there are a lot of hard money people.
Private money stepped in when the banks and everybody kind of backed off. And so they filled that gap, and a lot of the funding came from, I don't know, private equity or private investors. And there's just word on the street. I don't know how bad it really is, but there's word on the street that a few of the big hard money players are, a large percentage of their portfolios aren't performing right now. So they're doing a lot of workouts and a lot of working with people that are in major trouble.
You think those are on flips or like smaller stuff?
I think it's more hard money that got into commercial, because honestly, I mean, I don't know. Do you feel like the flips have slowed? Like it's harder to make money doing a flip?
Absolutely.
Yeah. Have you seen the same thing on the hard money front?
What do you mean?
Where the lenders are struggling? Or do you know of any lenders?
Not at all.
Really?
Yeah, no, because they're not exposed to the bad market.
Yeah. So if they got into commercial, you mean?
Well, I mean, hard money on flips is just a shorter cycle. So you're no longer exposed to big construction projects. So no, I haven't heard any issues there. But what people don't realize is, you know where I make my money on the flips? Is because I can get your $150,000 remodel done for 90. There's my $60,000 in profit. Yeah. It's all it is. Yeah. That's the only difference.
Yeah.
They think it's the buy. No, it's that you don't lose money when you actually can buy it.
Oh.
Yeah.
You're a better operator.
That's all it is. It's operations. There's no other way to create value in this world.
Yeah.
Money is not giving us free value anymore. Money is taking value from you at the start. So you have to create more of it.
Explain
that again.
Money used to just give us value. You borrowed it and you got a return just by borrowing it. Like now it's just harder to borrow. And
do you think it'll go back to that?
I think our asset values, which our economy is fully dependent off of, because our economy is based off perception, means rates can't get any higher. Because if rates get higher, we can't withstand any more lowering of asset values, because at some point a deleverage has to happen if you lower the values. So we don't have threat of rates getting higher because we have to keep values here to avoid a deleveraging. But asset values are too high as a whole, and so we can't get rates down. And so I think we're just in this channel for a period of time until we can produce our way into, now we have enough inventory that we can withstand some. And that's where, if you look at the way Jerome Powell speaks, for everything that we can say that he doesn't understand housing, which is kind of true, he does understand supply channels.
Yeah.
So he looks at housing, he's like, we still have an undersupply of housing, because he looks at it as just a supply chain standpoint. So from that aspect, I think we're just in this channel of interest rates, which it's fine. We can transact, we can operate, but you have to create value. So you can no longer just park money and then let money work for you. You have to park money, create value, and then money will work.
Isn't
for
that
you.
kind of how it should be, though?
Absolutely. Well, yeah, absolutely. It should be that way.
Otherwise, it's just too easy, and everybody's doing it, and it gets out of control.
Correct, and that's where that wealth divide comes from. It's
that
too
was
easy.
what we said right when we started the podcast.
Well, think of it this way: if it's too easy to make money just because you have money, that just accelerates the wealth divide, and that's what puts us in the scenario we are: is the expense load, right? The expense load at the typical consumer level puts restrictions on what we can do at the asset valuation level.
Are residential values resetting right now? Are they correcting at all?
They're fine.
Do you foresee in your crystal ball that they're going to come down at all?
I don't. I think they hit the bottom and they've just been crawling along the bottom. I think you have these little windows. These windows where it's like, it feels a little extra cheap right now, a little heavily discounted. But it's just, we're kind of at the value and it's not getting worse.
So is this a bubble? Is this going to pop like the commercial side did?
No, because the smoke and mirrors financing, we won't let it happen.
Well, and the financing's already, we're already down on rates. If it were going to pop, I feel like it would have popped
already.
When it was higher.
We felt the same way about commercial, that there'd be blood in the water 3 years ago, and it took this long for
and that's where I say
that I don't think that there was going to be.
Yeah, the residential market, you just don't even have threat from that bubble because of the
30-year mortgages.
Yeah, the fundamentals of the financing. I think there's a lot of threat in the commercial world, but again, this whole the richest people are based on asset values, right? So unless they can go purchase all those assets, they don't want them to fall value-wise.
You're talking about the rig system.
Yeah, right. So now you can manufacture a quick loss in asset value, you go buy assets, but you don't want a deleveraging and a collapse of asset value. Playing with it's fine. That gives you the ability to buy and sell and trade equity and stack equity, but we don't want a full-on asset value fall and deleveraging, and I think that's what they're doing.
So you're saying BlackRock isn't out buying houses like they were a few years ago. Now they're buying apartments and commercial buildings.
I think they're still buying both.
Yeah.
Office buildings?
I think when you're the stack the size of BlackRock, it doesn't matter what's happening. You just want to, it's just a matter of how are you deeper on the sales side or deeper on the acquisition side? You're always doing both. You're just changing the intensity of either side.
Turning the faucet.
Yeah.
I read an article yesterday that what was it, Dr. Fruits or whatever, he gave a presentation. He's an economist, and he talked about Oregon and the doom loop and all this stuff. But I think he was talking about the U.S. Bank Tower, the big pink tower, and how that traded at 40-something million bucks or whatever. And he was saying that's basically the land value. I mean, that's kind of what they're looking at right now. And you've always talked about buying deals, Mike, as kind of a land banking. It's like I bought the building, but I bought it for the value of the land. And it's amazing that a building like that could trade at essentially what it would cost for entitled dirt to build the same building.
Like if you think at your asset level, the very base level of your asset value is the land, right? So if you can buy it at the base cost and it comes with an income stream, you won the game. You're getting the lowest cost you can get and the income stream's already there. That is the definition of winning, in my opinion.
A covered land play.
Covered land play. There's nothing better than it.
I agree.
No one regrets the covered land play.
I think we have two good ones.
Everyone regrets. Well, not everyone, but a lot of people can regret the land banking, but the covered land play.
Yeah. Two very different things.
Yeah, I still don't understand how you make money in land. I'm not, and I know we've bought a couple covered land plays, and it's exciting, but I still don't understand.
Well, you've got
fully.
the most killer covered land play of all time.
Really?
Yeah.
In Corvallis?
Yeah. You don't even act like you don't know which one it is.
Okay, I kind of know what you're talking about.
I did it.
Think of it this way: buying land is not like buying a house. If you buy a single family house, that seed is already a plant. If you buy land, it's a seed that if you water will grow a plant. So you're just buying value. There's a whole lot of, you got to get the
What if there's
water
already
right,
kind of a
but-
crummy plant on it though? But
Well,
like not
you
too
just gotta
bad.
pull some weeds. Sometimes you got to weed the garden before you plant some seeds.
Yeah. No, I think that's what a covered land play is though, right? Is where you just got kind of like a lame plant on there. Like it's not a weed, but it's kind of like, nah.
Yeah. Hey, you just,
That's good for now. I'm going to wait until spring.
you're like, I can water it and it doesn't take too much of my water resources.
I'd be so mad if I was listening to this podcast.
So
What are these guys talking about?
let's wrap it up on optics.
Yeah.
We talked about optics. So what are the optics right now?
I would say my lens on optics is the Dunning-Kruger. So but there's a reason people say if it feels too good to be true, it's because it is. And in 2022, it felt like it was too good to be true, and that's because it was, right? And in 20, 21, and 22, and 20, you're maybe fine if you got long-term debt, and then buying stuff in 22 on short-term debt, you're dead. And there's a lot of people that are dead. So moral of the story is like. There's a lot of stuff that got posted on.
Send hugs and kisses to your operator who bought in 22.
Yeah, seriously, on 3-year debt or bridge debt or whatever it was. But I mean, there's a lot of people who post a lot of stuff on the internet that's just like so, and it drives me batty. And I told Trevor right when we got into it that the last thing I was ever going to do was sell my soul to social media, because I just I hate the FOMO that it gives other people. I also hate the optics, and that's the piece that like where you act as though your life is better than it really is, and it's like life's hard for all of us. Like
You guys give me FOMO. You're skiing powder in northern Japan.
I didn't post a single picture about it. I didn't post a single
posted
picture
video,
about it.
and I'm
Yeah.
like, I wasn't even mad you're in Japan because I was just there, but I wasn't.
Yeah.
I wasn't snowboarding in 4 feet of fresh powder.
Oh my goodness, it was incredible. Sorry, everybody. It was very fun.
I had FOMO. FOMO.
But that's not really what I'm talking about as much. And it's like Trevor and I worked the whole trip. Like I got a phone call at 3 a.m. that I took and it woke me up, and I was like, I should probably answer that. But it was noon in Oregon, and so it's like. You didn't, but I didn't post that on Instagram. Like
that you're working
that's
the whole time.
Yeah, it's like we worked the whole. Like I woke up at 4 and would work until.
You're not real.
Whatever.
You need to post that shit.
Like, well, I didn't post any of it, but to that point, it's like I think there's a lot of people who act like they're doing a whole lot better than they are.
Like what are you saying? Like the guys.
The guy's posting about buying crazy deals and like it's all working out. Like this is what I bought this week, and it's a different deal type. It's like if there's people switching up what deals they're doing all the time and buying in markets that they don't know. It's not going to work in the end.
So it's another way to underwrite a syndicator or sponsor is to find out how many deals they've done in the market that they're actually doing.
Totally.
So you don't want to go with somebody on their first deal to the Sun Belt if they've never bought in the Sun Belt before.
Well, and also if they're going to post videos about how good their deals are, they better be posting videos about how good their outcomes have been on their other deals. I mean, that's in a time where everybody's outcomes weren't.
Oh, you're
really
saying
good.
rather than how good a deal's going to be that they're raising money for, they should be talking about
How good it was.
So you're saying they
how did
shouldn't
we
come
do?
on our podcast and say they've never lost money? You saying we shouldn't trust those individuals that come on our podcast and say they've never lost money?
Oh,
I can't. I'd have to.
Yeah.
We'll talk about that off air. I don't know what you're talking about. I'm blanking. But anyways,
if
that's
you're-
my take on
so
it.
you're
What's
saying
your
if you're
take on
in the-
optics?
If you're in this industry and exposed, especially exposed over the past 3 years, do not claim you've not lost money. No one believes you. You're a fucking liar.
That's the optics. And that's that.
I lose so much money.
Doesn't mean you've lost money overall, but there's vacuums of loss.
Yeah.
I've made a lot of money. I've lost a lot of money. I don't know where I'm at. I'll have to look at the scorecard. I think I'm ahead. Right.
It doesn't matter, Gabe. You smile every single day.
You know what I will say is I'm okay losing my money, but I am not okay losing investor money. That does not work for me.
I would put my money into the deal, then distribute it, and then in the newsletter say, "Hey, we actually would have lost money on this deal, but instead I just decided to lose some money on it."
Yeah, I look at that a whole different way.
It terrifies me. That's why I'm only doing deals that we could all fund the losses of. All right.
Optics. There it is. All right, guys. Deal Junkies, we love you. Thanks for listening. Please share us with your best friend who can get something out of this, and we will see you next time.